About capital asset pricing model. What is capital asset pricing model? It is a model that explains the relationship between risk and return for investment, and it indicates the required rate of return of a risky asset. And this required rate of return can be determined by taking this formula. And RJ refer to the required rate of return for stock J. Risk-free rate, RFR is a risk-free rate, RM is the market return, and RM minus RFR is a market risk premium. And basically this formula shows that these two components affect the required rate of return. Risk-free rate actually refer to the interest rate of an asset that is derived by assuming there's no uncertainty on the future cash flow. And risk premium refer to the additional risk that investors expect to receive for bearing risk, right? So if you look at this formula, required rate of return for stock J is determined by its own beta. And what exactly is beta? Beta, if you are putting this information into a diagram, beta is basically the regression slope of the regression line. Okay, beta is a slope of a regression line on the data of individual stock return, right? In addition, beta measure the risk of a company in relation to the risk of the market, right? Example, it measure how much the stock can move compared to the market, and therefore it indicates how the price of a stock respond to the market forces. For example, when market interest rate increase, this is market, right? When return on the market increase, how much will be the return of RJ increase? Okay, so beta will give you some idea about that. Okay, having looking at what is cap M and what is beta, you can actually compare the required rate of return with the estimated rate of return to decide whether the stock is undervalued, overvalued, or properly valued. Okay, from the required rate of return, you will draw a SML line, which is a graphical depiction of capital asset pricing model. Okay, then from here, you compare the required rate of return with the estimated return. When your required rate of return is higher than the estimated return, you will say that the stock is overvalued. However, if your required rate of return is lower than the estimated return, you will say that the stock is undervalued. And in the condition where the estimated return equal to the required rate of return, you will say that the stock is properly valued. Okay, let's look at one example. And you are given two stock P and Q, and these are the given information on beta, standard deviation, and estimated return. Given the T-bill of 5%, T-bill is the indicator of the risk-free rate, and market return of 16%. This is market return. Okay, first determine the required rate of return for both stocks. Okay, using this formula, put the information on this formula. Okay, risk-free rate is equal to 5 for R, and beta is 0.9, and return on market is 5, and risk-free rate is 5. And you will see that the required rate of return for stock P is 14.9, and required rate of return for Q is 8.85, lower than the stock P. Okay, then whether these stocks are undervalued or are overvalued, then you need to compare this required rate of return compared with the estimated return. Okay, putting this information into a diagram, okay, and you will see that this is your SML line, graphical depiction of the capital asset pricing model. When beta equal to 0.9, okay, your required rate of return is 14. Then you draw there's a point here. When beta equal to 0.35, the required rate of return is 8.85. Then you have another point here, and the risk-free rate is 5. You draw a line, and this is your SML line. Then you compare. For stock P, the estimated return is 12%, and the required rate of return is 14.9. Estimated return is 12. It is located here. Therefore, because of required rate of return is larger than the estimated return, you will say that the stock P is overvalued. On the other hand, the required rate of return for stock Q is 8.85. However, the estimated return is 14%, which is located here. Therefore, stock Q is overvalued. Right? Interpret the value of beta. Beta is equivalent to 0.9 and 0.35 in this case. So beta for stock P is more responsive to changes of market compared to the beta for stock Q, which is 0.35.